Please hand your quizzes in. Please hand your quizzes in towards the end of each row. Thank you.
You add that in the minority. Michael said.
Thank you.
Yeah, but I don't know how to get from
Any more quizzes out there? Please hand your quizzes in. Okay. I know you probably don't want to talk about the quiz right now, but now is probably the best time to actually talk about it. Okay? Let's take problem 1. Okay? Messy problem, right? In fact, there's only one real issue in that problem. What do you do with minority holdings, and what do you do with minority interests, right? Everything else is pretty straightforward. Standard definition of enterprise value is what? Market value of equity plus debt minus cash divided by EBITDA. This company has minority holdings in some companies and majority holdings in others, right? Let's go item by item. What's in the market value of equity? It includes all your holdings. Minorities, the 10% you own of company A, the 60% of company B is all in that market value. What's in your debt? 100% of the parent company and 100% of the subsidiary that's fully held. Cash, EBITDA. 3 of the items in that calculation have 100% of the parent company and 100% of the sub that's fully held. The market value of equity is the odd man out. That's what's causing the whole problem here, right? You've got to make it consistent with everything else. There are 2 ways you can make it consistent. One is you can strip out all the cross holdings from everything, but you don't have the information to do that here, right? What do you not have? You don't have the debt of the subsidiary, you don't have the cash, you don't have the EBITDA, so you can't go back to the parent company's, just the parent company's EV to EBITDA. So the minimum you can do to make this consistent, at least make this the consolidated company's enterprise value, consolidated company's EBITDA, which means 100% should be in everything, right? Debt, cash, and EBITDA are already there, so you don't have to do it. The number that's standing out here is the market value of equity. If you add the minority interest, which is in market value terms, you've basically brought in the portion of the subsidiary that doesn't belong to you. And you have to subtract out the minority holdings. And I know you guys I could see you looking at that, subtract it, no, leave it alone, untouched. The problem with it is it's going to create an inconsistency. Here's the inconsistency. Let's say you own 10% of a company, you leave that in your market value of equity. There is no way in which you can adjust all the other inputs for the 10% of the minority that you own. Right? I'm not going to sit there saying 0 or 2. I mean, I bend over backwards to give partial credit. So I'll give you plus for debt, minus for half point. No, even though those equity, you copy the number down. EBITDA, good. It's right there. You know? So the point of the exercise is not to say, oh, you know, 0. It's to make sure that EV to EBITDA, and you're going to run into this a lot as you go out and start practicing it, is an incredibly messy multiple when you have cross holdings. So all I want is this quiz, the reminder. Every time you see EV to EBITDA, I want you to have a bit of a nightmare before you actually use it, because it should be a bit of a nightmare. What? For what? How do you adjust for it? The only way you could adjust for it is if I told you the percentage of the majority holding that belonged to you, then you, and the EBITDA of the subsidiary. Otherwise, you don't even know the EBITDA of the subsidiary. There's nothing, no information here about the subsidiary for you to do any cleaning up, right? Yep.
Could you assume that the minority interest percent to your equity was?
The minority interest is a. The minority interest represents the portion of the equity that doesn't belong to you. Right.
So if you calculate that percent of.
But of what though? You can't take it as a percent of the total equity, right? The total equity is both the parent and the subsidiary company. If you take a percent of that, you're acting like the entire value is the subsidiary's value. What you get as a market value of equity is 100% of the parent company's equity plus 10% of company B plus 60% of company C. That's all in that market value of equity. So what you see as 1,000 is actually the market value of equity of 3 companies embedded in one number. So it's difficult to separate out what's causing what. The minimum you have to kind of clean up for those minority holdings you have in other companies to make at least sure that the numbers match up. Because otherwise you're going to have an inconsistency that feeds into your multiple. 2A was pretty straightforward, right? That's the price earnings ratio, the intrinsic. I mean, I might have thrown off in the wording intrinsic value of equity. There's a reason I had to word it that way. If I asked you for a PE ratio, then the second problem would have been even more confusing. The second part of that problem. So the first part I said, you got the growth, you got to the return equity. Basically, it's a standard price earnings ratio. You can do price to book if you want. I mean, there are lots of different ways you can get to the right answer. 2B is messy again, and it's messy on purpose. I threw in options in there, right? In the first part of the problem, you actually get the value of equity for the firm, the total value of equity. That value of equity is divided among 2 claim holders, common stock holders and option holders in the firm. Right? So if you come up with 10 billion, I think you're right, the answer I came up with, and I don't even know whether this is right, 16 billion or something as the overall value of equity. $500 million of that goes to the option investors. The rest, or maybe it's a small number, so don't get scared if I throw that number out. I don't even remember anymore. $500 million of that overall value of equity goes to the option holders. The rest goes to the common stockholders, right? So the 900 million shares, no. So the price per share you're going to use will be based on the 900 million shares and the portion of the equity that belongs to common stockholders. The denominator, which is the fully diluted earnings per share, is the total net income divided by the billion shares outstanding. Again, a complete mess, but that's exactly what you have when you have the price earnings ratio for a technology company. Okay? When you see a diluted PE, remember that. The numerator is all messed up. You've taken out the option value. The denominator, I don't know what you've done, but you've come up with the earnings per share, including options outstanding. So you can already see the PE ratio you get, the first part will not match up with the PE in the second part because of the option screw up. Okay. That's it. That's all I wanted to say about the quiz. So the usual rules apply. I will take a look at them this evening. I will get them back to you as soon as I can. I don't want to hold on to them because corporate finance quiz is on one side. Yep. What? Oh, 1B. Somebody help me out here. What was the first 1B? What did I say? Company C takes its cash and does what? Retires debt, right? So if you look at EV, the EV computation, cash goes down by 200 million, debt goes down by 200 million. It looks like it offsets each other. But your debt ratio changes after the process, right? Sorry? Buyback shares. I'm sorry, buyback shares. So equity goes down by 2, but basically there'll be offsetting effects, right? But here's the one thing that will change. If you buy back equity, will your debt ratio change? So will your debt ratio change? Will your cost of capital change? If the cost of capital decreases, what happens to your value as a business? It goes up, right? So if there were no effect on the cost, if you lived in a Miller-Modigliani world, you can do all this as much as you want and nothing is going to happen. But we don't live in a Miller-Modigliani world. Okay? You have no idea who I'm talking about. Miller-Modigliani, that's it. Your corporate finance is blanked out on you. In a Miller-Modigliani world, remember your cost of capital stays the same at every debt ratio? We don't live in that world. Your cost of capital changes, and the direction of the change is going to determine whether the EV to EBITDA is going to go up or down. If your cost of capital decreases, your EV to EBITDA will go up because your firm So operating assets will now be worth more because you have a lower cost of capital and the same cash flows. So the answer to 1B, I think, was the very last choice, right? So that, no.
We get half if we said
The
it.
second to last choice. If you got very close to that one, even if the completely wrong answer, maybe I should give half credit for this, right? Okay, so that's about it. The private company valuation was pretty straightforward. Let's return to where we were on Wednesday. We were talking about real options, and we talked about the option to delay, right? We talked about the value of a patent at Biogen. I have an excess. I'm going to take that option to delay we talked about and use it to value undeveloped natural resource options. Let me explain what I mean. Let's suppose you own an oil company. Your oil company has developed reserves from which it extracts oil, sells the oil, gets cash flows. That's a conventional cash flow. But your oil company also has undeveloped reserves. It owns the rights to these reserves. It can choose to develop them if it wants to, or it can choose not to develop them. I'm going to argue that in that case, you have an option. An option to do what? You have the option to develop those reserves. What will determine whether you do it? If you're going to look at what it costs you to develop the reserves, million, billion, 2 billion, whatever it's going to cost you, you're going to see how much oil there is under the ground and how much you will get by extracting the oil. And if the value of the oil under the ground is greater than the cost of developing the reserve, you will develop the reserve and get the cash flow. But if that's not the case, you will sit on the reserve and hope and pray that oil prices go up. Yes? Yep. I'm sorry? Yep. The question is it already been done, or is it? It's a, essentially, we're looking at you've got past the kind of surveying. So by the time you bid, remember for these reserves, you bid based on what you think is under the ground. So that's where the initial cost is going to be, is to get those geologists, surveyors, whoever you get out there, to get a sense of how much oil there is in the ground. Now you've got to a stage where you have a rough sense of how much oil there is in the ground. You've bid and you've now got the reserves. This is when the clock starts ticking on the options. Are you going to develop or not? Okay? So let's draw it in terms of a payoff diagram. The cost of developing the reserve becomes the equivalent of the strike price. You will develop the reserve only if you think the value of oil under the ground exceeds that cost. If that's the case, you will develop and make the difference. If not, you know what you lost? Talked about what Kevin was just talking about, which is the cost you've spent to get these reserves, the exploration cost, the surveying cost, all of that becomes the price of the option. So let's think about this in terms of getting inputs to an option pricing model. Let's go through the inputs in terms of option pricing, and let's think about how we'd come up with each of the numbers. First input I need is the amount of the value of the reserves under the ground. To get this, first I need a sense of how many barrels of oil I think there are under the ground. For simplicity, I'm going to assume that's a given. So the geologist has told me 200 million barrels, I believe him. I'm going to estimate the value of the oil based on oil prices that I see today, the forward market. So basically, at this stage, I'm doing a conventional discounted cash flow valuation. How much is the oil worth? What are the cash flows? What's the present value? That becomes the S in the model. If you develop the reserve today, what would the cash flows look like? The cost of developing the reserve, putting the rig up, doing all the physical infrastructure costs becomes the equivalent of the strike price. Remember, you haven't done it yet. You can choose to do it. You can choose not to do it. The life of the option is the period that you get the rights to develop this reserve. Remember, as an oil company, you don't get this right in perpetuity. It's 15 years, 20 years, 25 years. The clock starts ticking. That becomes the life of the option. The variance in the value of the underlying asset. What's the one thing I'm uncertain about? If I assume the amount, the quantity is known, what is uncertain is the price of oil. So the variance in the price of oil becomes the variance I use in the option. You can already see why this option is going to be easier to work with than the patent option, right? Unlike the patent option where I could not look up the variance, I can look up the variance in oil prices. It's a publicly traded commodity. I can look up spot prices. I can look up standard deviations. That's going to become the variance in the option. As in the previous option, I'm going to introduce a cost of delay. You know what I mean by cost of delay? Your reserves become viable. Oil price at $60 a barrel. So basically, it says go, right? Part of you wants to go and develop the reserve. The other part of you says, let's hold on, maybe oil price will go to $100 a barrel, right? If I introduce no cost to delay, you know what you're going to do, right? You're going to sit and sit and sit and wait because there is no cost to waiting an extra year. So here I say, look, if you wait an extra year, what you're going to give up are the cash flows you'd have got by developing the reserve today. Again, I'm introducing a prod saying, at some point, I want you to develop these reserves, and that's going to come about because the cost of delay exceeds whatever you gain by waiting. Here's the last item that I have to worry about. Let's say you're ExxonMobil. Oil prices go to $100 a barrel. You decide to develop your reserves. You pick up the phone, you call. Where's ExxonMobil's headquarters? New Jersey somewhere? So wherever you are, Texas, Dallas, okay, pick up the phone, you call. Develop all the reserves immediately. So oil start coming out of the ground the next day? It takes a while. Between the time you decide to develop reserves and oil comes out of the ground, it might take a year, year and a half, 2 years, because that's how long it takes to get the physical infrastructure in place. You see why this matters? Why did you decide to develop the reserves? Because oil prices hit $100 a barrel, right? So you say develop the reserves. 2 years later, the oil starts coming out of the ground. What are you afraid of? Oil prices might be down to $35 a barrel. I'm not crying because of your quiz. It's just a terrible allergy, so just don't misunderstand here. Right? So basically, the present value that you lose here is that if you wait the year, 2 years, 3 years to see the oil from the ground, that's going to affect the value of your option. So let's set this up. I'm going to take a very simple example of an undeveloped reserve, use the framework we've developed to value the reserve, and then expand out to valuing an entire oil company. So let's say you're an oil company looking at one reserve that you have. You want to value that reserve. There's an estimated 50 million barrels of oil under the ground. Your geologist has gone through, he's pretty comfortable with that estimate. And if you develop that, the cost of developing that reserve today is going to be $600 million. If you decide to develop the reserve today, you've got to spend $600 million today. So you know how much oil is under the ground. You know what's going to cost you to develop the reserve. Based on oil prices today, let's assume you think you can make $12 per barrel of oil coming out of the ground. So this is the price per barrel minus the marginal cost. That cost can vary across the world. It can be very low in parts of the Middle East. It can be much higher in parts of Canada. So it basically is the difference. So right now, this is what it looks like. It will cost you $600 million to develop the reserve. Right now, it looks like there are $600 million worth of oil under the ground. Looks like an at-the-money option, right? But here's the catch. It'll take you 2 years before you can get the oil out of the ground. So there's a development lag of 2 years. So you spend the $600 million today to develop these reserves. You have to wait 2 years to see the $600 million of oil come out of the ground. So in present value terms, you can already see that's going to affect whether you exercise this option. Last couple of inputs. Once you develop the reserve, the cash flows you get out of the reserves will be roughly 5% of the value of the oil under the ground. So in other words, I've introduced a cost of delay. Once the reserves become viable, that's what you lose by not developing the reserve. Riskless rate is 8%. Variance in the log of oil prices is 0.03. Variances will always look small. 0.03 in percentage terms, what's that? This is a trick question. Let's see if you can get this. If I give you a variance of 0.03 in percentage terms, what's a variance? Sounds like a trick question, but humor me. Looks like 3%, right? It's actually 300%. Know why? Let's say your standard deviation is 20%. In decimal form, that's 0.2, right? What's 0.2 squared? 0.04. What's 20% squared? 400%. Variances are percentage squared. That's why when you look at a variance number, it'll always seem, what I'm trying to say is when you look at the variances, that's a really small number. But before you jump to the conclusion, remember variances, you have to move the decimal point 4 points over. So that's actually not a small number, 300% variance. So let's see the inputs to this particular model, okay? Value of oil under the ground is 600 million. Since you have to wait 2 years, you give up the cash flows for the first 2 years. So this is like doing a capital budgeting project where I say the first 2 years, I'm not going to get cash flows. So basically, I'm going to discount the 600 million back by 2 years to come up with a value of 544 million. The value of oil under the ground in present value dollars is 544 million. The cost of developing the reserve is 600 million, so it's an out-of-the-money option. You have 20 years that you can develop this reserve over. Oil prices are volatile. 0.03. That's driving the value of the option. Riskless rate is 8%. And every year that you wait, once it becomes viable, you lose 5% of the value because that's the cash flow you could have extracted. S, K, R, T, sigma, and Y. Basically the inputs I have in the black shell. Plug them in. D1, D2, N of D1, N of D2. Remind me again, what does N of D2 measure? What is that 60.3%? We talked about this in the context of Black-Scholes last session. It's the risk-neutral probability that what will happen? That this option will be in the money, right? In this case, you know what that's telling me? Even though this reserve is not viable today, over the next 20 years, there's a 60.3% chance that this reserve will become viable. Why? Because oil prices are volatile. Plug in the numbers in the Black-Scholes, the value that I get for this undeveloped reserve, which is not viable today, is 97.08 million. It's not viable, but it's still worth 97 million. You know how I'd use this? If I had to bid on this reserve, and the governments often put up oil reserves for bidding, that is my reservation price. I'm not going to be stupid and walk in and offer 97 million. I'm going to try 1 million, 2 million, but that's the price I should be willing to pay for this reserve because oil prices are volatile. Any questions? Yes? Yep. ND1 actually is tougher to read. They're both probabilities. ND2 in option pricing is the risk-neutral probability that S will be greater than K. ND1 is related to ND2, but I can't give you as much of a intuition. In fact, the way I read this is an estimate, right? There's a 60 to 85% chance, the ND2 to ND1, that this reserve will get developed sometime over the life of the option. So use the 60 as a lower bound, 85 as the upper bound, but technically the ND2 is the number you should be focusing on for a probability. Any other questions? Yes?
Yeah, just a question. So the idea is that oil prices may change in 2 years, right?
Or in any time over the next 20.
Right.
It's not just 2 years, right? You have the rights to develop the reserve anytime over the next 20 years. Oil prices may change, but the change you're interested in is an upward change. They could change in either direction. If they go down, this reserve will become even more non-viable. But if they go up, it will become viable.
But the calculated return price, you use the oil price today.
Yeah.
And then you discounted that price.
Right now, when you do S, you've got to take what you know today. What you know today is today's oil price and what's in the futures market. You use that to come up with the predicted cash flows on this reserve. So anytime you do S in a real options model, the value that you use as an underlying asset, act like you're developing the reserve today. Based on what you know today, what prices are today, this is what the expected cash flows will be and what the present value will be.
So you'd look out in the future, I guess. You'd go into the futures market and see.
Yeah, so you could use futures price, but those will be real prices. So in a sense, you have to use today, you can't use let's use an optimistic price or a pessimistic. You have to use prices you would get today if you develop the reserve today. Right? Any other questions? So the value of the reserve here is 97 million, and it's determined by what happens to variance in oil prices. So that's with one reserve. You take a big oil company. Big oil companies own dozens of reserves, hundreds of reserves, even thousands of reserves. Technically, you could take each reserve and value it as an option, but that's going to be a huge job, right? 1,000 reserves, you'd be doing this 1,000 times. So I'm going to cheat. I'm going to take all of these reserves, bundle them up, and value them as if they were one big option. Let's see how much your option pricing mechanics kind of hold up here. Is that kosher? I mean, in fact, let me give you an analogy, and you tell me whether it's okay to do this. Let's suppose you took the S&P 500, okay? You took an at-the-money option on each of the 500 stocks, and you valued each option. So you're going to get a portfolio of options, right? Then I'm going to give you a second option, which is on the entire index. I give you an option where the strike price is equal to the level of the index rate. So I get an option on a portfolio and a portfolio of options. Which is going to be worth more, the option on the portfolio or the portfolio of options? Why is the portfolio of options going to be worth more?
Because you can exercise each one differently. What's it called? The option on a portfolio, it's individually. So you have only one underlying asset.
Did everybody get what Luis is saying? Which is a portfolio of options is always worth more than an option on a portfolio. Simple reason. Practically, you get to try this on 500 different stocks because you get one option. It's yes or no on that option. There's actually a statistical way of proving this, right? What's a variable that most drives the option value? The variance of the underlying asset, right? Remember portfolio theory? You take 500 stocks, you bundle them, you create an index. The variance of the portfolio is going to be lower than the variances of the individual stocks that go into the portfolio. Why? Because they're not correlated perfectly with each other. When the correlation is less than 1, combining stocks in a this is your first foundations of finance, very first class in finance. Combining two assets reduces the variance because they're uncorrelated. That's why I could not do this if I were trying this on the S&P 500. I'm going to argue that in this case I'm going to be able to get away doing this. Here's why. What's the only variable I've assumed in the oil reserve valuation? Only thing I'm uncertain about is the oil price, right? So if I have 1,000 reserves, and the only variable that I'm uncertain about is the oil price, all 1,000 reserves are perfectly correlated with each other. The oil prices go up, they all go up in value. Oil prices go down, they all go down in value. If they're perfectly correlated, there is nothing lost by taking all of the reserves and doing it as one big option rather than doing 1,000 options. And think of how much time it saves. So it is an approximation, but in this case, because I'm assuming that the only uncertainty is about the oil price, I think you can get away doing it. You can take the entire bundling of reserves and value it as if it were one option. Let's try this. Do oil companies actually report undeveloped reserves? They do, with a catch. What do they actually report? Not all undeveloped reserves. What do they report? Proven reserves. What the heck are proven reserves? In option terminology, what options are they reporting on? They're actually reporting only their in-the-money options. That's the definition of proven, is the reserve is there. It's not just that you know how much oil there is, but that you have to actually be comfortable that the value of the oil actually exceeds the cost. So they're giving you only their in-the-money options. What you'd really like all oil companies to do, and they're starting to move towards this, is for them to break their reserves out, not just into proven reserves, but all undeveloped reserves. And then you'd like them to give you information on each layering. What's the cost of developing these reserves, these ones? We're not there yet, but we're starting to move towards that point. Because as an investor, I'd like to know, it's not just that Petrobras has all these billions of barrels. I'd really like to know what the cost of developing Reserve A, Reserve B, Reserve C is, at least in average terms. We don't have that yet. So here's what I had to go back to try to apply this to a real oil company. I was actually able to get this information for one oil company way back in time. This was in 25 years ago almost now. A company called Gulf Oil, which was the target of a hostile acquisition. The reason I was able to get it is in the process of the hostile acquisition, all this information came out. The oil companies actually have this information right now. They just don't need to disclose it. So here's what the information looked like at the time of the hostile takeover. The hostile acquisition was at a price of $70 per share. The company had 165.3 million shares outstanding, debt of $9.9 billion. So that's kind of background information. What made Gulf Oil attractive to the acquirer was they had reserves of 3.038 billion barrels. This is the total undeveloped reserves, with an average cost of developing these reserves of about $10 per barrel. So right now, if they developed every single reserve they have, it's going to cost them $30.38 billion. The average life of these reserves was about 12 years. There was some 3-year reserves, 5-year, 10-year, 20-year. The average life was 12 years. So it's almost like a consolidated life for all of these reserves. At the time that I did this, the price per barrel of oil was $22.38, 1984. And the cost per barrel extracted from the ground in these reserves was about $7. So they're going to make about $15.38 per barrel of oil that they get out of the ground. T-bond rate was 9% at the time of the analysis. And Gulf was expected each year to produce about 5% of the reserves and get that as cash flows. That's your cost of delay. Variance in oil prices, I've left at 0.03. Let's see what the value of these undeveloped reserves is, valued as an option. Okay? So here's what I did. First step in the process, I took the 3,038 million barrels and I asked a hypothetical question. In a minute, I'm going to ask you why this has to be hypothetical. I assume that all these reserves would be developed instantaneously. See why this is hypothetical? If they actually tried to develop all these reserves instantaneously, they're going to affect the oil price, right? So here I'm going to keep it as if they can do this without affecting the oil price. So take the 3,038 million barrels, I multiply by $15.38, which is what I make per barrel, and I lose the 2 years because of that development lag. So basically, if I look at the present value, the cash flows I'd get, if I develop the reserve today, it's about $42.38 billion. That's a traditional DCF valuation. It cost me about $30.38 billion to develop the reserves right now. Let me stop there. If I did a traditional discounted cash flow valuation of these reserves, what's the value that I'm going to come up with? 42.38 minus 30.38 is 12 billion. File that away. That's my conventional DCF valuation of these undeveloped reserves. I have 12 years that I can play this game, right? These reserves are already in the money, but I can wait. Maybe oil prices will go up. The riskless rate over that period is 9%. The variance in oil prices is 0.03, so oil prices could change. And every year that I'm waiting, I am giving up some cash flow. So that's captured in that 5% cost of delay. I plug it into the model. Consolidated option with all these inputs. ND1, ND2. Remind me again, what does ND2 measure here? These reserves, there's an 85% chance, and there's no surprise in that because it's already viable, that I will develop these reserves sometime over the next 12 years. But here's the miracle of option pricing. What is my DCF value for these reserves? 12 billion, right? Plugged into an option pricing model, these same reserves are worth 13.3 billion. So here's my question for you. Where's the extra 1.3 billion coming from? I seem to be creating value out of nothing, right? Where is that extra $1.3 billion in value coming from in the option pricing model? What is it I'm missing in the DCF valuation?
You're assuming that everything gets all
Developed
reserves are developed
immediately.
options. Yeah.
Immediately, right? Whereas in the option pricing model, what do? I look at the oil, it's not just the time value, I look at the oil price to decide how much to develop and how quickly to develop. So if oil prices go to 40, I develop a lot more. If oil prices drop to 10, remember the learning and adaptive behavior that options are based on? That's what I'm missing when I attach a $12 billion value to these options. I'm adding an extra $1.3 billion to reflect the optionality in this model. So this is the value of the undeveloped reserves. It's not the value of Gulf Oil as a company, because Gulf Oil as a company is worth not just the undeveloped reserves, but it's also worth its developed reserves. So here's the second layer in my valuation, and this is similar to the biotechnology company we did last with Biogen. Okay? I took the value of the undeveloped reserves, that takes care of the, then I took the developed reserves and acted as if that's the only asset they had. Okay? Basically, my estimate was that about $915 million in cash flows they were getting from these developed reserves, and if they did nothing, there were 10 years of developed reserves they could exploit. I took the present value of $915 million over 10 years. That gives me $5.065 billion. So that's the value of the developed reserves basically run into the ground. You say, how come you're not applying a growth rate to those cash flows? Because the growth is going to come from developing the undeveloped reserves. I've already valued those undeveloped reserves. I can't double count those reserves. You add the 5.066 billion, subtract out the debt, the value of equity per share that I got, valuing the company based on option pricing models is about $51.25. The acquisition price was $70. How do I explain it? I don't have to. I didn't pay the price. It doesn't make sense to me. But as we're going to see next week, a lot of things that happen in acquisitions make no sense at all. So add this to a layer of unknown, unexplainable things. Yes?
You have other unproven reserves with technology.
Yeah, but now we're reaching, right? So if you believe that, never ever use garnishing after the fact to explain away that $18. So if we are concerned that there's something we're missing, then let's value them and bring it in. In fact, when I presented this to a bunch of oil executives, they argued that we were missing the physical assets of the oil company. They said we should be adding the value of the refineries, the ships, all the physical assets on top of the value that you get here. But that I don't get. What's wrong with doing that? We'll come back to that. Why can't I add the physical assets onto this value? Because those are the assets that produce the cash flow. You can't count an asset and the cash flows on that asset in the same valuation. So in this case, if you're going to go beyond this, you have to have assets that have real cash flows. Yeah.
In this case, you don't have perpetuity, so you can cast.
But be careful. Why don't I have a perpetuity here when I do the developed reserves?
Because the reserve's finished.
Right.
But all the machines used for these reserves can still be sold after 10 years.
What are you going to do with a used rig? All right. I mean,
I don't know, it's scrap metal.
okay. So maybe there's salvage value. If that adds $18.75 per share, then all the more power to you. So that's possible, right? But remember, when you value the undeveloped reserves as options, you are assuming the company continues. It's not like the company shuts down after 10 years, right? So be careful. The $13.3 billion that I'm attaching to the undeveloped reserves does assume a continuing company. So the fact that these developed reserves run only 10 years doesn't mean at the end of the 10 years I shut the company down and I liquidate it. So you have to be careful that those assets are not needed for my undeveloped reserves to get developed somewhere along the way. Louis?
But you're assuming it only lasts 12 more years, right?
I'm assuming it lasts only 10 more years. The undeveloped reserves, the right to develop the reserves lasts only 10, 12 more years. If you start developing the reserves, presumably the oil from these reserves will continue beyond the 12th year, right? So the optionality lasts only 12 years. If you assume that the reserves,
The prices that you are using, you're studying for 4 years, right?
for the expected cash flows, the first step, I'm just taking all of the reserves, producing them all today till I run out of reserves, which might be in 12 years, 13 years, 14 years. But that's assuming I start today. If I start in year 8, those cash flows will continue through year 19, year 18, right? So in a sense, it's going to be a moving target. You can't just, if everything ended in year 12, you'd be right. But then you'd really have these reserves getting developed very, very quickly because you give up too much by not developing the reserves.
Using your methodology,
Right.
how do you keep a constant, because oil companies normally want to keep a constant reserve, because otherwise analysts penalize them a lot. If they produce a lot now.
See, but that's why I said this is a hypothetical. The fact that you're assuming they develop the reserves doesn't mean you actually develop the reserves. You're saying if they did develop the reserves, this is what the cash flows will be. The actual operational characteristics might be that they will develop only a certain percent of the reserves every year. Once you've attached the option value, what that's going to determine is how much of the reserves or how much of the option gets eaten up next year, 2 years out, 3 years out. So a value Gulf oil, 1 year from now, 2 years from now, 3 years from now. The amount of undeveloped reserves, developed reserve proportions might change depending on exploration, adding new reserves, and my developing existing options. So this is going to be a kind of a dynamic approach where I have to revisit this every year.
I understand that concept, but I don't see the terminal value. My point is I don't see the
Oh, there is no terminal value. So I'm conceding that because of the way I'm doing this, there might be some point, but I'm saying it might not be year 12. It might be year 17, year 18, year 19, and that might be adding value. I'm not sure how much value it adds to Carnot's. Yes?
Two quick things. First, isn't better just to use average the price option price model like the Asian option, for instance, to have a better sense of the
Average price for oil to get the cash flows today, or?
you will have the revenues throughout the period.
Right.
Not
Well, you can use the average, or you can use forward markets to actually get predicted prices. So you can actually use which is going to be pretty close to today's price adjustment.
future,
Right.
you will only have the spot price.
Right, but still, can't you lock in the price? If you develop the reserves today, at least for a short-term period, you can lock in the price at which you can sell the oil. So it's not even an expected price. You could actually line up people you're going to sell. So it's a transaction price. It's not just an expectation. Once you get past that, then you're right. Maybe you have to make expectations of the oil prices. But for the period that you can actually lock in the price, might as well use an actual price. The futures price is the forward price.
And the second thing about the refinery,
Right.
if you're considering in the revenue the crude oil
Right.
barrel, you should consider the refinery because the refinery is
Add
adding
it.
value to the
If it adds extra profits. In a sense, if there is a refining profit, so that'll actually add third layers, fourth layer, fifth layer to this process. There are other ways you're adding value to this process. I try to capture that in my marginal cost. What I showed as the profit was actually net of all costs. But if you actually did it in terms of each layer, you could actually end up with different layers of value to an oil company. Let's step back. Any oil company's value then comes from both developed reserves and undeveloped reserves. Developed reserves you value as traditional discounted cash flow models. The undeveloped reserves have an option value. Okay? Let's play a little game. Let's suppose, what are oil prices right now? About $50 a barrel? Let's suppose they double next week. Don't ask me what. Middle East crisis of some sort, which is always there. Doubles next week. And the week after drops back to 50. So 2 weeks from now, you're back to where we were today. Same oil price. Will oil company values have changed as a result of the 2-week? Why? Same oil price, so the cash flows are pretty much the same. So what's changed in these 2 weeks? The variance in oil prices, the implied variance, the forward-looking variance, is now going to be higher because of the shock you just got at the system. Think of the consequences. A company like Petrobras that gets most of its value from undeveloped reserves now will get a jump in value because the option value has become much higher. Companies like ExxonMobil that get the bulk of their value from developed reserves will not gain as much. So on a relative basis, I would expect Petrobras to become more valuable relative to ExxonMobil if the variance in oil prices goes up. It's a testable hypothesis. Look at the implied variance in oil prices. See which companies benefit and lose. Option pricing will predict that there will be differences across companies. Any questions? So let's take real options through the test to see whether they pass the test. First, is there an option? Clearly there is. There's an underlying asset. There's oil under the ground. You will develop the oil only if the value of the oil is greater than the cost of developing the reserve. Is there exclusivity? Where does the exclusivity, or put another way, think of where the exclusivity comes from. It comes from the fact that this is a natural resource and there's only so much of it under the ground. If oil prices get to $200 a barrel, it's not like you and I can go into a backyard and start digging, right? You could, but you're not going to hit oil. Effectively, what creates this optionality is the fact that you have a scarce natural resource. In fact, you can extend this argument to any resource which is scarce. Real estate in New York City should have an option value. Think of what? On Manhattan, let me take that back. Real estate in Manhattan should have an option value. Because you're on an island. There's only so much land. You can't real estate in Kansas City should have no option value. I mean, think about it. Land goes out as it's flat land, every direction you want. You want to grow. If you go to Vegas, when you land, look at how the city sprawls, right? There's no limit to it. There should be no option value if you can just sprawl. In fact, in New York City, because of the real estate restrictions on how you can build, there are layers of options in every real estate building. There's only so much in terms of square footage you can put on any given land. So if you built less than that, there's an option to add on. In fact, we got into trouble building this building. You might not know, we actually spent 2 years getting an architect to come up with this building. It had 13 floors in it. So 2 years later and several $1 million later, they put this, they put a model of the building in the old school. And then we had a faculty meeting, and the dean said, we have a problem. And of course, we knew this was not good news. He said, we thought we had some X thousand square feet on this land because that's what, but NYU actually borrowed some of the square, don't even ask me how these things get done. They were borrowed square footage from this land where there was nothing and put it into Coles, to build Coles. So they said, we've lost about 20,000 square feet. So our suggestion was just take off 2 floors. He said, we can't do that. We have to go back to scratch and build it again. It cost us another year to actually build the building because we didn't factor that in. So keep that in mind. When you look at real estate, you can actually argue that because you have limited resources, there's scarcity in some parts of the world, that real estate can have optionality. Last question, can I apply option pricing here? Remember, to apply an option pricing model, the underlying asset has to be traded. The option has to be traded. Didn't work with patents, right? Here you actually have a shot. What's the underlying asset here? It's the oil under the ground. You actually have a shot of trading the underlying asset, trading the option, and actually natural resource options are the closest you get to your ideal real options example. The reason I think that real options have their deepest roots in natural resource options. Mining companies, gold mining companies, oil companies have been bigger users of real options than any other set of companies out there, and you can see why. It comes closest to passing all 3 tests. Let's stop there. We will pick up with the option to expand in the next session.